Hello and welcome. In this video, we will discuss the three fundamental, powerful investing principles that should guide, that must guide, and that actually guides your investing decision. Before I jump on the topic of today's video, I would like to ask you, how is the series going? Investing Master Series. Is it powerful? Are you learning? Are you enjoying? Do give me your feedback in the comment box, chat box, and I'm eagerly looking forward to your comments. Right? Do hit the like button, do subscribe to our channel, and I'm looking forward to see all your comments. And I'm gonna personally look at the comments. Right? My YouTube channel is something very close to my heart. It's this community is something very close to my heart. So I do look at it personally. Do comment. Thank you. So let's jump on to investing principles. What are the fundamental three investing principles that should guide your investing journey? So the three investing principles that we can talk about are: number one, diversification; number two, duration; and number three is a non-correlation. These are the three super powerful fundamentals of investing activity. Like, I'll just move like this so that you can read the third point clearly. It is non-correlation. If you want, what I can do is I can just keep my video away so you can read it properly. There are three principles: diversification, duration, and non-correlation. Now, what do you mean by diversification? What do you mean by diversification? Diversification typically means never ever invest all your money into single asset class. Please understand, I am not talking diversification from the perspective that you can't invest all your money into shares of one company. Talking about that. I'm talking from a very broad perspective that even you cannot invest all your money into equities. You cannot put into FDs. Hello, everybody. This is something that senior citizens might not love to hear because, see, if you see the history of Indian investing, equity came into picture in probably last decade, since 2010 or off late, after the mutual funds came into market, and in fact after mutual funds got the boom, that is where equity investing became very popular in India. But earlier, if I talk to your parents or to your grandparents, majorly all the senior peoples were only focused on, or rather I would not say focused, the only source of investing for them is bank FDs. They used to get salary, they used to do business. Whatever money is left, whatever money is saved, just do the FD, do the FD, do the FD, do the FD. I don't know about you, but this is the culture in which I am grown. If you can resonate with me, just type in with you in the chat box. If you can resonate with me, just type in with you in the chat box. I'm grown in that culture. Like my parents, my father, I'll tell you, he started investing in equities at the age of 72. Recently, he consulted me like, Amit, I want to open Demat account. I was like, oh my God, who is talking to open Demat account, right? So that's how it has been. But uh, still, I would say they were very wise. They were not investing in equities, but our parents and grandparents have always balanced between gold, FDs, and real estate. I hope you agree with this. You can give agree into me. So I'm not saying my parents, your parents, or our grandparents never did the diversification. They were wiser than us. They have followed the diversification principles. Only equity class was not that prominent. Now, with the young age people, the liquidities have increased, and even earlier, if you look back, the equity markets were not that liquid, and the facilities were not that. If you see, like if I and you want to invest in equity share, almost every broker gives a beautiful app. You just need to take your phone in hand, press the button, and your shares are bought. Earlier, there used to be, deliveries and settlement. People had to go to stock exchange. They had to shout the prices, and that all used to be the scenario, right? If you have seen all that, you can type me in the chat box. So, on a broader perspective, I'm saying that never ever invest all your money into one single class. Proper diversification is the key to investing. You got to balance, like if you put, and in fact, recently I was reading one book which is called The Millionaire Next Door. Very popular book, very good book, very famous book. You should also read that. In that, I read that the wealthiest people in the world, the wealthiest people in the world do not invest more than 30% of their total wealth in equity. Like you and I generally feel like, okay, equity is the only source. Equity, let's buy share, let's buy share. But wealthiest people in the world history has never invested more than 30% in direct equities. That's what the Millionaire Next Door book said. I was just reading a few days back. So mutual funds are good investment to instruments to diversify. It gives you diversification in many ways. Like even if you're buying equity mutual funds, it puts your money into different companies. It doesn't buy share of just one company. Let's go even one step above. There are mutual funds with comes with a which comes with a investment objective of putting 30% into equity and 70% into debt, 60% into debt, 40% into equity, 60% into equity, 40% into debt. There are arbitrage funds. So if you want to balance that, you can go for a good mutual fund. You can take help of a good mutual fund distribution, take advice. But I'm telling you, it's a good. Second investing principle that should guide your investing journey is the duration. So duration, when I mean that, which kind of asset to invest usually depends on the duration for which you wish to remain invested. This is very crucial. Like for example, you got some money, like for example, you got 5 lakh rupees extra which you are ready to invest, but you are going to need that money in a 6 months time to pay the college fee of your son or to pay the college fee of your daughter, or your children marriage is approaching in 6 months time and you're going to need that money. So what I'm trying to tell you is you're going to remain invested for a period of 6 months, and definitely equity is not the right choice for that. Equity investment should be looked at only if you are willing to remain invested for a longer period, because in equity there is not only appreciation, there can be depreciation. Like the moment you invest and market crashes, like it happened in 2008, it happened in 2020 when COVID kicked in. World market, all stock markets across the world crashed. Even Indian market suffered two lower circuits. So God forbid you invest, markets are crashing, and now you need your money, so you will have to book loss. You will have to liquidate your investment at a lower price, and that is not ideal for you. So if you want to remain invested for a shorter period, it is ideal to go for the debt instrument, where return might not be that lucrative. The return might not be that lucrative, but there is a safety. And guys, this is generally what people in India think. Many people have done that mistake, that if they need money in 6 months time, instead of going for the debt instrument, they actually go for the equity. They think that, okay, in 6 months I'll double my money, I'll make 1.5 times of my money and I'll be rich. Oh, God's sake, don't do that. Guys, don't do that. If you committed this kind of a blunder, if you committed this kind of mistake, type I have done in the chat box. I want you to be honest with me, and that is the only way I can help you, right? And if you are really willing to remain invested for a longer period, then you can select equity or real estate. And again I'm saying, when you go for the real estates, you got to be understanding that there is a illiquid uh, characteristics involved within the real estate, uh, which will not allow you to liquidate your assets in a shorter period of time in case you need money. But of course, real estate should be looked at as a part of investment, and always keep in mind the risk and diversification. So now when I say that if you want to remain invested for a shorter period, you should always go for the debt, and for longer period, equity or real estate good. Now, people of my age, or people who are starting their investing journey at the age of 20 or 25 or 30, let's say 30, like people of my age, 35. I'm 35 when I'm recording the video. With God grace, we are doing good as far as earning front is concerned. I'm married. So, what I'm trying to tell you is, I've got a house, I'm totally debt free. I don't have a single rupee of debt on my head as of now. So, generally, people of our age think like, okay, I am not gonna need money in near future because I'm married. Generally, marriage is one thing where people need a huge money because they need to buy gold and all that. So people of 30, 35 age, they think that, okay, I've got a house, I'm married, I don't need money. So let me put all my money into equity because I am going to remain invested in the market for longer period. But that's not right approach. That's not the right approach. You should diversify. And I'm telling you, all the people of my age, if you're listening to me, please trust your brother. Even at the age of 30, even at the age of 25, even at the age of 20, you should have some debt component, some liquid component with you because you never know when you're going to need that money. If you agree with me, just give me agree in the chat box. Please, everybody, give me agree in the chat box. And the third and last concept is non-correlation. So non-correlation is very vital for wealth creation. In uncertain, geopolitical conditions, wars, an equity market generally crashes. I'm explaining non-correlation by the example. Now, even when I'm recording the video in the month of towards the fag end of June 2025, there is Iran-Israel tension going on. Russia-Ukraine war is also going on. America has jumped into Iran-Israel war, and God forbid if that turns into the World War III, the equity markets are going to crash. Now, guys, what if you have invested all your money into equity or equity driven products? When I say equity driven products, I mean equity mutual funds. Okay. So if you got, for example, 10 lakh rupees of equity, that is direct shares, and 20 lakh rupees of equity mutual funds, and if you're telling me, Amit, I've got diversification, oh my God, you are terribly wrong. You are terribly wrong because your asset does not have a non correlation. Equities and equity mutual funds belong to same asset class, they belong to same risk class. The only difference is in equity you have directly invested, in mutual fund a mutual fund distributor is, company is invested. Your equity portfolio will also be down, your mutual fund portfolio will also be down, and you will have to book huge losses in case you need money. So equity and debt, there is a complete non-correlation. In case of geopolitical condition, war, recession, equity markets may crash, but your debt instrument like corporate bonds and FDs, their interest rate will not be iota affected. Banks will pay you the interest what they have committed. Your capital is going to remain safe, and that is what you should look for. Always, guys, prepare for the worst. Be ready for the worst. See, when as an investor or particularly when as a young investor, we look at the returns. Like I want to make this money, I want to make wealth. But my dear, you also got to be looking at the risk part because life is always uncertain. You never know when you're going to need the money, right? So this is the concept of non-correlation that I wanted to teach you. And always make sure your investing portfolio balances non-correlated asset classes like equities and metals. Equities and metals, we cannot say they are non-correlated. Actually, they are inversely correlated. If equity market is going up, generally it has been observed that gold markets and metal markets are going down. And in the time of uncertainty like wars and all that, equity market crashes, real estate market generally crashes. but metals are signing, their prices are going up. So they are actually not non-correlated, they are inversely correlated. But when you talk about debt, it is non-correlated. It has got nothing to do with what happens with the equity market, what happens with the gold price, or what happens with the real estate. It will give you a fixed stream of income. So I hope you understood the core principles of investing. You're learning something. Again, like every video I'm going to tell you, I want you guys to tell me in the comment box what is your biggest learning from the three videos. And I want you to write down three core principles that guide your investing journey in the comment box. Thank you and see you in the next video.